Welcome to your ultimate pit stop, Piston Pundit. Today, we're shifting gears from the racetrack to the financial fast lane as we explore how a massive $390 billion sell-off of U.S. Treasuries could send shockwaves through the global economy. Buckle up, because this is more than just a market adjustment. It could be a direct response to Trump's hardline trade policies. Let's dig into the key players, the underlying mechanics, and what this means for America's economic horsepower. Number 5. Foreign investment in U.S. debt. Why it matters. For decades, U.S. Treasury securities have been the go-to pit stop for countries seeking financial stability and reliable returns. The U.S. dollar has long been the world's reserve currency, which means when countries like China, Japan, and the U.K. sell goods to the U.S., they end up with hefty dollar reserves. Instead of letting those dollars sit idle, these nations have historically invested them in U.S. Treasuries, earning interest while maintaining currency stability. This setup creates a kind of financial codependence. Holding U.S. debt strengthens diplomatic ties and gives these countries leverage in trade negotiations. Plus, the Treasury International Capital (TIC) report, which tracks foreign holdings of U.S. securities, has always been a key indicator of global confidence in the American economy. But the recent sell-off hints at a tectonic shift. Dumping $390 billion worth of treasuries signals more than just a change in investment strategy. It suggests that global players are losing faith in U.S. fiscal policies and the stability of the dollar itself. For the American economy, this could mean higher borrowing costs, increased pressure on interest rates, and a serious hit to the dollar's dominance in global finance. But the selling spree doesn't stop there. Some of America's biggest allies are getting in on the action. Number 4. The $390 billion sell-off. Who's leading the charge? Between November 2024 and January 2025, foreign governments sold off nearly $390 billion in U.S. Treasury securities, one of the largest reductions in U.S. debt holdings in history. The biggest sellers included Brazil, $55.9 billion, Ireland, $42 billion, Cayman Islands, $41.2 billion, Canada, $37 billion, Norway, $35.6 billion, and India, $34.9 billion. Even major holders like Japan and China reduced their positions by $7.8 billion each, while close allies like the United Kingdom, $26.6 billion, and Singapore, $26.5 billion, also cut back. This coordinated divestment signals a major shift in global financial strategy. Rising U.S. interest rates have made older bonds with lower yields less attractive, prompting investors to seek higher returns elsewhere. Geopolitical tensions, including Trump's aggressive trade policies, have further shaken confidence in U.S. assets. Countries are also looking to diversify their reserves to reduce exposure to U.S. fiscal policies. Central banks are increasing their holdings of gold and other foreign currencies, signaling a shift away from the dollar as the dominant global reserve currency. The scale and timing of this sell-off reflect a strategic response to both economic and political uncertainty. If this trend continues, it could weaken America's ability to finance its debt affordably and erode the dollar's global dominance, with far-reaching consequences for the U.S. economy and global financial markets. But rising interest rates aren't helping the situation either, and they could be accelerating this global sell-off. Before we delve deeper, do us a favor and smash that like and subscribe button. This helps us reach more auto enthusiasts just like you. Now, let's shift gears and steer towards our next point. Number 3. The interest rate squeeze. Why higher yields are driving the sell-off. The Federal Reserve's recent rate hikes are the final twist of the wrench in this situation. As the Fed raised interest rates to fight inflation, it created a double-edged sword for bondholders. Here's why. When interest rates rise, newly issued bonds offer higher yields. That makes older bonds with lower rates less attractive, pushing down their market value. Foreign investors holding these low-yield treasuries are now cutting their losses and moving to greener pastures. And it's not just about returns. A stronger U.S. dollar, a side effect of higher rates, increases the cost of servicing dollar-denominated debt for foreign countries. That's why many central banks are looking for alternatives, increasing gold reserves, experimenting with other currencies, and even cutting back on dollar exposure altogether. It's a shift that could fundamentally reshape global financial dynamics. If the dollar loses its dominance as the world's reserve currency, America's economic leverage will weaken. The U.S. could face higher borrowing costs, increased debt pressure, and a more volatile financial market. But the real trigger for this shift may be Trump's hardline trade policies. Number 2. Trump's America First trade policies and global reactions. Trump's America First trade policies, including higher tariffs on China, Canada, Mexico, and the European Union, have triggered a wave of retaliation and economic uncertainty. Concerned about the impact on American assets, foreign governments are not only imposing counter tariffs, but also reducing their exposure to U.S. debt. The European Union has already threatened to target key U.S. exports like agriculture and automobiles if Trump's tariffs go into effect. Meanwhile, China plans to impose steep tariffs on American soybeans and corn, which would severely hit U.S. farmers and rural communities. China's state-run media has hinted that these tariffs are part of a broader economic strategy to weaken U.S. influence. China is also adjusting its financial strategy by shifting reserves from U.S. dollars into gold and other currencies, a clear move to reduce reliance on the American economy. Canada has taken a similarly tough stance, with Prime Minister Mark Carney announcing plans to eliminate internal trade barriers and impose up to $125 billion in countermeasures targeting U.S. exports. This strategic shift is already reshaping America's financial future. Number 1. The long-term impact on the U.S. economy and global markets. The $390 billion sell-off of U.S. Treasuries reflects mounting concerns over America's fiscal health. The U.S. national debt surpassed $35 trillion in early 2025, driven by increased government spending, tax cuts, and higher defense budgets under Trump's administration. Federal Reserve Chairman Jerome Powell has warned that rising debt levels and higher interest rates could weaken the U.S. economy. More of the federal budget will go toward interest payments rather than funding infrastructure and public services. Reduced foreign demand for U.S. debt could push bond yields higher, increasing borrowing costs for both the government and private sector, driving up mortgage rates and business loan costs, and slowing economic growth. The sell-off reflects a broader shift toward de-dollarization. Central banks in Russia, China, and India are boosting gold reserves and diversifying into currencies like the euro and yuan, reducing reliance on the dollar. If this trend continues, the dollar's global dominance could weaken, leading to higher inflation and more expensive imports for American consumers. Trump's tariffs are further complicating matters. Higher costs for imported components could raise vehicle prices by $1,500 to $3,000, hurting demand and leading to job losses in manufacturing states. Retaliatory tariffs could also hurt U.S. farmers by reducing demand for agricultural exports, creating surplus supply and lower prices. The verdict: a financial and political crossroads. The $390 billion sell-off of U.S. Treasuries is more than a market adjustment. It's a clear signal that global confidence in the American economy is fading. Rising interest rates, escalating trade wars, and Trump's protectionist policies have created an environment where even America's closest allies are looking for the exit. So, what's next? Can the U.S. reverse this trend and restore global confidence? Or are we witnessing the beginning of a long-term shift away from American economic dominance? What do you think? Are Trump's trade policies helping or hurting America's economic standing? If you enjoyed this video, hit that like button and subscribe to Piston Pundit to stay updated on the latest automotive and economic news. Thanks for watching and catch you in the next one. Also, you can now check out any of the videos on the screen. There's plenty more to explore.